What's up everybody, welcome to the channel. This is Sohail and today I want to talk about candlestick patterns. They are awesome for trading and they represent the purest form of technical analysis. They show the result of the battle between buyers and sellers in a period of time and what's the stance for bulls and bears to take the control of price in the next move. This video is going to be a comprehensive source of common and reliable candlestick patterns for you, covering 65 candles and patterns. If you're looking for a specific pattern, just check the description. I placed timestamps forwarding you directly to the pattern you want to know about. I'll start with the most basic and common candles and patterns, and we continue to the more advanced and rare ones. Let's get started. Alright, let's begin with long candlesticks. Long green candles show strong buying pressure. We have a long body and small shadows, meaning that high and low are close to the open and close. The further the close is above the open, the stronger the pressure. It indicates that in that time period, buyers were very aggressive and pushed the price up significantly. Long green candles usually represent the bull market and they show signs of more advancing, but it depends on where it's located. If it appears following a downtrend or near support levels, it may be a sign of reversal. And if it forms following an uptrend, it can be a sign of more buying pressure, or it may represent overbought and possible reversal. And for long red candles, whatever we just said about long green candlesticks is true here, but in the opposite direction. Here, the candle shows strong selling pressure. The further the close is below the open, the stronger the pressure. It indicates that sellers were aggressive in that time period and forced the price down significantly. They usually represent the bear market and more declining of the price, but the interpretation depends on where it's located. If it forms in an uptrend or near resistance levels, it may be a sign of reversal, and if it appears in a downtrend, it can be a sign of more selling pressure from the bears, or it may be a sign of oversold and possible reversal. Short candlesticks. Here, for short green candles, we have a small body and small shadows. It shows that buyers couldn't push the price up significantly and the closing price is not much further away from the open, and also the high and low are near to the open and close, which means that it's true that buyers closed the price higher than the open, but in the session we didn't have much activity to show more advancing pressure. It can be interpreted as neutral to somehow bullish, and this candle is usually interpreted with other candles as a part of a compound pattern, and alone it doesn't show any significant pressure. And here for the short red candle, the same story. Small body and small shadows. Sellers couldn't force the price down significantly, and in the session there is not much activity to show more declining pressure. Just like the green one, here also it can be interpreted as neutral to somehow bearish, and this candle is not interpreted alone because it doesn't show significant pressure and it's usually part of other patterns. Marubozu. In green Marubozu, we have only body and there is no shadows, meaning that the low equals to the open and the high equals to the close. The candlestick shows that buyers were very aggressive and they had full control from the starting point to the close. It shows high buying pressure, higher than the long green candlestick, and if it forms following a downtrend or near a support level, it can show the reversal, and if it appears in an uptrend, can be either showing higher pressure from the bull side or maybe a sign of excessive speculation and showing overbought and possible reversal. And for the red one, that's the sellers who took the control from the first trade to the last trade, and it shows a very aggressive selling pressure higher than the long red candlestick. Forming in an uptrend or near a resistance level can be a sign of possible reversal, and if it appears in a downtrend, it can show more selling pressure because of some reasons, or it may be a sign of oversold and possible reversal. Closing Marubozu. Bullish closing Marubozu is like Marubozu, but here we have a small lower shadow, which means that for some little times in that time period, sellers had the control and forced the price down lower than the open, but at the end, that's the buyers who took the full control and pushed the price up aggressively. For this candle, the interpretation is just like the Marubozu, and here we are encountering with aggressive buying pressure. If you see it in a downtrend or near support levels, it can be a sign of reversal, and if it's forming in an uptrend, it can show oversold and possible reversal, or it may be a sign of more advancing. And here for the bearish closing Marubozu, we have a small upper shadow, and just like the bullish one, here also we have a strong selling pressure and shows that sellers were in full control in that time period. If we have it in an uptrend or near a resistance level, it can show a possible reversal and declining of the price. And if it forms in a downtrend or near support levels, it can show oversold and possible reversal or continuation of the downtrend because of higher selling pressure. Opening Marubozu. Here for bullish opening Marubozu, we have a small upper shadow. From the opening, buyers had to control and push the price higher, but sellers were also active and managed to force the price down a little lower than the high. Just like other Marubozus, this Marubozu also shows strong buying pressure, maybe just a little bit weaker because of the upper shadow. And we interpret this candle like the long green candlestick, as I explained. And here for the bearish opening Marubozu, we have a small lower shadow. This candle is also strong like red Marubozu, but here buyers were more active in compared to the red Marubozu. So it may be a little bit weaker in compared to red Marubozu. And we interpret this candle just like the long red candlestick as I discussed. Spinning top. In this candle, we have a small body and long shadows. This small body is smaller than the body of short candlesticks we just discussed, and it shows little movement between open and close. So here for this candle, red or green doesn't matter. These long shadows show that both of the buyers and sellers were active in that time period, but none of them could take the control of the price, and it shows a kind of indecision and a standoff between forces of buyers and sellers. Interpretation of this candle depends on where it's located. If it forms following an advance or near a resistance level, it shows that buyers are weakening and there is a possibility for reversal. And if it appears following a downtrend or near support levels, it shows that sellers are losing strength and there is a possibility of changing in the direction of the price. Doji and its variations are very important, and they are part of other patterns which we'll discuss later in this video. In this candle, open and close are approximately equal, and in the ideal situation, the doji has equal open and close. The upper and lower shadows are small so that the doji looks like a plus sign. Just like the spinning top, dojis also show indecision and a standoff between buyers and sellers, but the degree of indecision is much more higher in compared to spinning top because none of the buyers and sellers were active in that time period, as you see small shadows here on dojis. Dojis are neutral candles and they don't mean anything but indecision, and their interpretation depends on where they appear and what's the previous candle. For example, a doji after a long candlestick is more significant than being after a short candlestick, and a doji forming in an uptrend or near resistance levels shows buyers are weakening, and a doji following a downtrend or near support area shows sellers are weakening, and there is a possibility for changing of the current direction of the price. Dojis are mostly used with other kinds of candles in a compound pattern, which we will cover them in this video. Long leg doji. This doji is similar to the spinning top, but here in the body, the open and close are approximately equal or totally equal in the ideal situation. The degree of indecision here is higher than the spinning top because we have no body and just shadows, which means a great amount of indecision. But in compared to the doji, I mean the plus sign doji, the degree of indecision is lower because in the session, the buyers and sellers were active and drove the price high and low, as you can see the shadows. This is a neutral pattern and its interpretation is like the spinning top, but long leg doji is more significant in compared to spinning top. If you see this candle in an uptrend or at resistance levels, it shows buyers are losing strength and there is a possibility of reversal. And if you see it following a downtrend or at support levels, it means that sellers are weakening and there is a potential of changing in the direction of the price. Cross doji and inverted cross doji. Here in the cross doji, we have short upper shadow and long lower shadow. Sellers were strong enough to force the price down significantly, but on the other hand, the strong buyers stepped in and took the control of the price and pushed it to the place it was opened. Cross doji is generally considered bullish and shows buying pressure, but the interpretation of being bullish or bearish depends on where it's located. This candle is the ideal version of the hammer and hanging man patterns, which I'll discuss them later in this video. And here for the inverted cross doji, we have short lower shadow and long upper shadow, which shows that in that time period, buyers strongly drove the price up. But on the other hand, finally, the strong sellers took the control and forced the price down to the opening level. This candle is generally considered bearish, showing selling pressure, but just like the cross doji, the interpretation depends on where it's positioned. Inverted cross doji is the ideal version of inverted hammer and shooting star patterns that the full explanation will be there for you later in this video. Gravestone doji and Dragonfly doji. This is a Gravestone doji. We have long upper shadow and no lower shadow, meaning that the open, low, and close are equal. At first, buyers had the control, and from the first trade, they pushed the price up and didn't allow sellers to drove the price lower than the opening price. But at the end, that was sellers who took the control and forced the price down to the level it opened. Gravestone doji generally shows the selling pressure and is considered a bearish candle, but its interpretation is similar to inverted cross, depending on where it's positioned, which is covered next in the inverted hammer and shooting star patterns. And here, this is a Dragonfly doji, which we have long lower shadow and no upper shadow, which means that sellers had the control from the first trade, but at the end, the strong buyers stepped in and pushed the price up to the point it opened. Dragonfly doji generally shows buying pressure and is considered bullish, but its interpretation is similar to cross doji depending on where it appears, which is covered in the hammer and hanging man patterns in the next part. Hammer. Here in this candle, we have small body, small upper shadow, and long lower shadow. The small body shows that none of the buyers and sellers had the control between open and close, so the color of the body doesn't matter because of the little movement here. And the long lower shadow shows that at first sellers had the control, but finally the strong buyers drove the price up somewhere near the open. If the open and close are approximately equal, the hammer becomes a cross doji, which gives more strength to our pattern. In the ideal situation, our hammer doesn't have the upper shadow, and in the case that it looks like a cross doji without the upper shadow, it becomes a Dragonfly doji, which is the most strong form of this pattern. This candle is generally considered bullish and it shows buying pressure, but the interpretation of being bullish or bearish depends on where it forms. This candle, when appears at the end of a downtrend or near support levels, it's called hammer, and here it shows buying pressure and there is a possibility of reversal and changing the direction of the price movement. And when this candle forms following an uptrend or near resistance levels, it's called hanging man. All we just said about hammer and its structure is true here, but with different interpretation. Here, the long lower shadow shows that sellers were strong enough to force the price down significantly. It's true that at the end, buyers took the control and drove the price up again, but the lower shadow represents starting of a selling pressure and sellers were active in that time period. So this candle with the position in an uptrend or near resistance, which we call it hanging man, is bearish here, and it shows the possibility of reversal and price declining. Shooting star. Here for this candle, we have a small body, small lower shadow, and long upper shadow. Because the body is small, we didn't have much activity between open and close, so the color of the body doesn't matter here. The long upper shadow shows that buyers had the control at first and took the price up significantly, but at the end, the strong sellers stepped in and force the price down somewhere near the open price. If there is no lower shadow, the pattern becomes stronger. Also, if the open and close are equal, it becomes inverted cross doji, which gives more strength to this pattern. And if there is no lower shadow, in the case of inverted cross, it becomes gravestone doji, which is the most strong form of this pattern. This candle generally shows selling pressure, but the interpretation of being bullish or bearish depends on where it's positioned. When this candle forms at the end of an uptrend or near resistance levels, it's called shooting star. And in this case, the candle shows selling pressure, so there is a possibility of reversal and declining of the price. And when this candle appears following a downtrend or near a support level, we call the pattern inverted hammer. Here in this situation, this candle is considered bullish and it shows buying pressure because buyers in that period of time were aggressive and were strong enough to drive the price to high levels significantly. So we have signs of increased buying pressure somewhere near support level or end of trend lines, which gives the possibility of potential change in the current direction of the price. Engulfing patterns. In bullish engulfing pattern, we have two candles. The first one is a short and red candle, and the second one is a long green candle. The body of the green candle must engulf the whole body of the short candle, and in the ideal situation, it also engulfs the shadows of the red candle. This short candle should not be a doji because dojis are easily engulfed. This pattern forms in downtrend or near support levels. When the last red candle is created on the chart, I mean this short candle, because of the selling pressure, the next candle is opened below the close of the short candle. But aggressive buyers did not allow the price to go lower and push the price higher than the red candlestick open. The longer the green candle, the stronger the pattern and the more possibility of changing in the direction of the price. And here, for the bearish engulfing, the first candle is a short candle, a green candle, and the second candle is a long red candle. The body of the red candle should engulf the whole body of the short candle, and ideally it must also engulf the shadows. Just like the bullish engulfing, here also the short candle should not be a doji. Bearish engulfing pattern appears near resistance levels or at the end of uptrends, and it shows the selling pressure and possibility of reversal. The longer the red candle, the stronger the pattern. Dark cloud cover. In this pattern, we have two candles. The first is green and the second is red, and both of them have fairly long body with small or no shadows. It's not a must for shadows to be small, and with longer shadows, the pattern can be still correct, but not so long shadows. After the last green candlestick that is made, which is the first candle of this pattern, because of buying pressure, the next candle opened above the close of this green candle, but sellers quickly took the control and did not allow the price to go higher and drove the price lower than the half of the previous candle. This pattern shows selling pressure, and we see it in advances or near resistance levels, which gives the possibility of reversal. And piercing pattern is the mirror image of the dark cloud cover. Here the first candlestick is red and the second is green. Both of them are fairly long with small or no shadows. As I said, with longer shadows, the pattern can still be valid. This pattern appears in downtrends or near support levels, and after the last red candle, which is the first candle of this pattern, we have a long green candle which opens below the close of the red candle and closes higher than the midpoint of the red candle. It shows buying pressure and the possibility of reversal and changing in the direction of the price. Bullish Harami. This pattern forms in downtrend or near support levels, and it shows the possibility of reversal. As you see, we have two candlesticks here for this pattern. The first one, which is the last red candle of the prior trend, is a long candlestick, and the second one is short candle with small body and shadows, which is totally included in the first candle body. Harami in Japanese means pregnant. The first candle is considered to be the mother and the second candle the baby. The color of the second candle doesn't matter because it's small and there is not much activity between open and close. The smaller the second candle, the stronger the pattern, and if the second candle is a doji, it's the highest possibility of reversal for this pattern, and it is called bullish Harami cross. And bearish Harami is similar to the bullish Harami, but in the opposite direction. Here, bearish Harami appears at the end of uptrends or resistance levels, and it shows the possibility of reversal. The first candlestick is a long green candle, which is actually the last candle of the prior uptrend, and after that we have a small candle which is totally included in the body of the previous one. The color of the baby candle doesn't matter, and the smaller the baby, the stronger the pattern, and with being a doji gives the highest possibility of reversal for this pattern, and we call it bearish Harami cross. Bullish kicker, this pattern happens following a downtrend or at support levels, and it shows the possibility of reversal. It consists of two candlesticks. The first one is a long red candle, which is expected as we are in a downtrend, but the second candle is a long green candle that opens in the open price of the previous candle, or sometimes even with a gap from the open of the red candle. This pattern shows significant change in the market attitude, for example, because of fundamental changes in a company. And the bearish kicker appears in an uptrend or near resistance levels, and it shows a potential of reversal and declining of the price. Here, the first candle is a long green candle, which is expected, and after that, we have a long red candle which is opened in the price that the previous candle was open, and sometimes even with a gap, which shows a significant change in the market attitude and possible reversal of the direction of the price. Morningstar, this pattern appears at the end of downtrends or near support levels, and it shows the possibility of reversal. The first candle is a long and red candle as we expect in the downtrend, and after that we have a small candle that opens below the close of the previous candle. The color of this candle doesn't matter, red or green, because the body is small. And the third one is a long green candlestick that opens above the body of the previous candle. The first candle shows the selling pressure, and when the second one opens below the previous close, it indicates even more pressure, but buyers stepped in and didn't allow the price to go lower, and the result is a small candle. The smaller the body, the stronger the pattern, and in the case that it's a doji, we call this pattern morning doji star, which is the strongest form of this pattern. And when the third candle, long and green candle is made on the chart, it confirms the possibility of reversal. And evening star is the mirror image of the morning star. Here the pattern forms following an uptrend or near resistance levels. The first candlestick is a long green candle as we expect, and after that a small candle opens above the previous candle close, and the color of this candle, red or green, doesn't matter because of the small body. The third one is a long red candlestick that opens below the body of the previous candle, and it confirms the reversal, the possibility of reversal. As I said, the smaller the second candle, the stronger the pattern, and if it's a doji, it would be the strongest form of this pattern, which we call it evening doji star. Bullish abandoned baby. This pattern is very similar to Morningstar with just small differences. Here also the pattern forms at the end of a downtrend or near support levels, and it shows the possibility of reversal. The first candlestick is long and red as expected, and the second one is a doji that opens below the low of the previous candle, and the third one is a long green candle that opens above the high of the doji. Actually, there is a gap between the doji and the other two. When the second candle opens below the low of the previous candle, it shows high selling pressure, but suddenly buyers took the control, and the result is a doji, which is a complete indecision and a standoff between buyers and sellers. And with the third one opens with a gap up from the high of the doji, the possibility of reversal is confirmed based on this pattern. And bearish abandoned baby is similar to the bullish one, but in the opposite direction. Here the pattern forms at the end of uptrends or near resistance levels, and it represents the possibility of reversal. The first candle of this pattern is long and green as we expect, and the second one is a doji that opens above the high of the previous candle, and the third one is a long red candle that opens below the low of the doji. With this third candlestick formed, the possibility of reversal based on this pattern is confirmed. Bullish tree star. In this pattern, we have 3 consecutive dojis that appears at the end of a downtrend or near support levels. The first doji shows indecision, and it can be with a gap down or just in the closing price of the previous candle. The second doji gaps down and opens below the first doji, and the third doji gaps up and opens above the second doji, which shows that market sentiment is changing and there could be a possible reversal. And the bearish 3-star is exactly similar to the bullish one, but in the opposite direction. Here, the pattern forms following an uptrend or near resistance levels. We have 3 dojis. The first doji can be opened with a gap or no gap. The second one must open above the first one and there must be a gap. And the third one must open with a gap below the second one that shows there is a potential for changing of the direction of the market. 3 white soldiers. This pattern forms following a downtrend or at support levels. It's made of 3 candlesticks and 3 of them are long green candles with small shadows. The second one is open in the body of the first one and closed above the previous candle close, and also the third one is open in the body of the second one and closed above the previous candle close. That confirms the possibility of reversal based on this pattern. And 3 black crows is similar to 3 white soldiers but in the opposite direction. It forms at the end of uptrends or near resistance levels. The second candle is open in the body of the first one and is closed below the close of the previous candle. And also the third one open in the body of the second candle and by closing below the previous close confirms the possibility of reversal based on this pattern. 2 crows. 2 crows is a bearish reversal pattern and it forms in an uptrend or near resistance levels, and it shows the possibility of reversal or changing in the direction of the price. It's made of 3 candlesticks. The first candle is medium to long, just the way as we expect in an uptrend. The second candle is a short red candlestick and its close is above the first candle close, so we see a gap between bodies. And the third candle is fairly long. It's a red candle that opens in the body of the previous candle and closes in the body of the first candle and cover the gap. It shows selling pressure and possible reversal. And also we have upside gap 2 crows that is somehow similar to the 2 crows with just very small differences. This is also a bearish reversal pattern and it appears in an uptrend or near resistance levels. The first candle is just a normal green candle we expect in an uptrend, and the second candle is short and opened and closed above the first candle close, meaning there is a gap between the 2 bodies. And the third candle is also a red candle which engulfs the body of the second candle. The third candle shows increased selling pressure and the possibility of reversal. In compared to the 2 crows pattern, upside gap 2 crows has less strength because the gap is not covered yet, but still it shows selling pressure and possibility of reversal. 3 inside up. This pattern is a bullish reversal pattern and it's made of 3 candles. The pattern appears at the end of a downtrend or at support levels and it shows possibility of reversal. The first candle, as we expect in our downtrend, is a medium to long red candle, and after that we have a short green candle that is totally inside the body of the first candle, and the third candle is a long green candle that is open in the body of the second candle and it's closed above the first candle, and this shows that buying pressure is high and sellers are weakening and there could be a possible reversal. Pay attention that if the second candle body is small, this pattern becomes an extension of bullish Harami, and with the third candle we will have a very significant possibility of reversal. And 3 inside down is a bearish pattern that appears following an uptrend or near resistance levels, and it shows the possibility of reversal and changing in the direction of the price. The first candle is a normal green candle as we expect, and the second candle is a short red candle that is totally included in the body of the first candle, and the third candle is open in the body of the second candle and it closes below the first candle. As I said, if the second candle body is small, this pattern becomes an extension of bearish Harami with very high degree of possibility for reversal. 3 outside up. This is a bullish reversal pattern that forms following a downtrend or near a support level. We have 3 candles in this pattern. The first candle is usually short to medium, but whatever the sizes, the second candle is a longer green candle that totally engulfs the first candle, and the third candle opens in the body of the second candle and closes above that. This pattern is an extension of engulfing pattern, and the difference is that here in this pattern with the third candle opened with a gap down and closed above the previous candle shows significant buying pressure and higher possibility of reversal. And 3 outside down is a bearish reversal pattern. It appears at the end of uptrends or at resistance levels and shows the possibility of reversal. Just like the bullish one, here the first candle is green and in the direction of the trend and is usually short. The second one is a longer red candle that totally engulfs the first candle. And the third one, by opening in the body of the second candle and closing below it, shows high selling pressure and significant possibility of reversal. Bullish meeting line. This is a bullish reversal pattern and it formed at the end of downtrends or near support levels. This pattern is made of 2 candles. The first candle is a long red candle in the direction of the trend as we expect, and the second one is a long green candle that opens with a gap and fills the gap and closes at the level that is equal to the previous candle closing price. As it's clear, this gap shows a high selling pressure, but buyers suddenly stepped in and took the control of the price and covered the gap and closed it significantly higher in the price previous candle closed. This shows a high buying pressure and possibility of reversal. And on the other hand, bearish meeting line is a bearish reversal pattern that happens following an uptrend or near resistance levels. Here, the first candlestick is a long green candle as we expect, and it shows high buying pressure. And after that, the second candle opens with a big gap, but sellers managed to fill the gap and force the price down to the level previous candle closed. And this shows that buyers are weakening and we have a high selling pressure and there may be a possible reversal. Bullish belt hold. This is a bullish reversal pattern that appears in downtrends or near support levels. In this pattern, we have 1 candle, which is a bullish opening Marubozu, a long green body, no lower shadow, and a small upper shadow, as I explained this candle at the start of this video. This candle is open with a gap and then filled the gap, and it shows high buying pressure and possibility of reversal. Just pay attention that because this is a 1 candle pattern, it can happen in combination with another pattern and be part of other patterns like bullish engulfing or piercing, for example. And bearish belt hold is a mirror image of the bullish one. Here, this pattern appears following an uptrend or at resistance levels, and we have a bearish opening Marubozu that is opened with a gap and then filling this gap, which shows high selling pressure and possibility of reversal. As I said, this pattern can be in combination with other patterns because here we have 1 long candle in this pattern. 3 stars in the south. This is a bullish reversal pattern and we have this pattern forming in downtrends or at support levels. The name may be a little bit misleading because here we don't have a small candle with gap which is named star in other patterns. The first candle is a medium to long red candle with no upper shadow or just very small upper shadow and long lower shadow, which shows that sellers are weakening. The second candle is a short red candle that is opened in the body of the previous candle and closed below the previous candle close or just at the closing level of the candle, and the low must be above the previous candle low. And the third candle is a small candle with no shadows that is totally in the body of the previous candle in the ideal situation or just closes in the high-low range of the second candle. This pattern perfectly shows that sellers are gradually weakening and buyers are taking the control, and there may be a possible reversal and changing in the direction of the price. Advanced block. Advanced block is a bearish reversal pattern that appears at the end of uptrends or near resistance levels. This pattern is made of 3 candlesticks. The first candle is a medium to long green candle with small shadows, and after that, the second candle opens in the body of the first candle and closes above the previous candle close with relatively smaller body, and the upper shadow is relatively longer in compared to the first candle. And the third candle also opens in the body of the second candle and closes above the previous candle close, and the body is short and the upper shadow is long, just like the second candlestick. These openings with gaps, smaller bodies, and longer upper shadows show that buyers are gradually losing strength and the selling pressure is increasing and there is a possibility of reversal. Bullish stick sandwich. This pattern appears in downtrends or near support levels and it indicates the possibility of reversal. The first candle, as we expect, is a medium to long red candle with small shadows. The second candle is green and opens in the body of the previous candle with a gap and closes above the previous candle open. The third candlestick is a long red candle that opens above the green candle close and closes at the approximately same price that the first candle closed, and this shows that a support level has been established at this price level and there is a possibility for changing in the direction of the price. And bearish stick sandwich is the mirror image of the bullish one. Here the pattern forms in an uptrend or near resistance levels and it shows the possibility of reversal. The first candle is green, medium to long as we expect, and the second one is red and opens in the body of the first candle and closes below the first candle open. And the third candle is a long green candle that opens below the previous candle close and closes at the approximately same price the first candle was closed. That shows that a resistance level has been established here. Matching low. Matching low is a bullish reversal pattern that appears in downtrend or at support levels. This pattern is made of two candlesticks. The first one is a long red candle and the second one is also a red candle shorter than the first one, open in the body of the first candle and is closed at the price level that the first candle was closed. If the second candle has a shadow, the shadow should not go lower than the first candle shadow if there is any. This pattern shows that a support level is being established here and the selling pressure is decreasing, which gives the possibility for reversal. And matching high is a bearish reversal pattern that happens at the end of uptrends or at resistance levels. The first candle is a long green candle and the second one is a shorter candle that is open in the body of the first candle and is closed at the price level that the first candle was closed. Which shows that a resistance level is being established and there is a possibility of reversal and changing in the direction of the uptrend. Tweezer. Tweezer top is a bearish reversal pattern that forms in an uptrend or near resistance levels and shows the possibility of reversal. The first candlestick is medium to long green candle as we expect in this uptrend, and the second candle is a shorter red candle that opens and closes in the body of the first candle, and the high for this candle is equal to the high of the first candle, which shows that a resistance level is establishing and there is a possibility of reversal here in this uptrend. And in Tweezer bottom, which is the mirror image of Tweezer top, we are in downtrend or near support levels, and the first candle is just a normal red candle as expected. And the second one, which is a shorter green candle, opens and closes in the body of the previous one, and the low for this candle is at the same price level of the low of the first candle, which shows that the support level is establishing and the direction of this downtrend may change. Bearish breakaway. Bearish breakaway is a reversal pattern forming at the end of uptrends or resistance levels that shows possibility of changing in the direction of the uptrend. We have 5 candlesticks in this pattern. The first one is a medium to long green candle, and after that we have a short green candle that is opened above the first candle close, meaning we have an upward price gap and shadows here can overlap. And then we have another 2 short green candles that each of them is open in the body of the previous candle and is closed above previous candle close. And finally we have a medium to long red candle that is opened below the previous candle close in the body or below the body and is closed below the second candle opening price and above first candle closing price. This formation shows that buyers are gradually weakening, and on the other hand, selling pressure is increasing, which gives the possibility of reversal. And bullish breakaway is exactly similar to the bearish one, but in the opposite direction. Here, this pattern forms in a downtrend or near support levels and gives the signal for changing of the direction of the price. Here, the first candle is medium to long red candle, and after that, a short red candle that opens with a gap below the first candle close. Shadows here can overlap. And then another 2 short red candles, each opening in the body of the previous candle and is closed below the previous candle close. And finally, a medium to long green candle that is opened above the previous candle close in the body or above the body and is closed above the second candle open and below first candle close. This pattern shows that sellers are gradually losing control and buying pressure is increasing, and there could be a possible reversal based on this pattern. Upside Tasuki gap. This is a bullish continuation pattern. It formed in an uptrend and it shows that the trend is going to continue. This pattern is made of 3 candlesticks. The first one is a green candle, medium to long, just a normal candle in an uptrend. And after that, we have a short to medium green candle that is opened with the gap, and its low must be higher than the previous candle high. And the third one is a medium red candle that is opened in the body of the previous candle and is closed above the first candle close. And it means that it couldn't fill the gap, and it shows that sellers are not strong enough to change the direction of the price, and the uptrend continues. And downside Tasuki gap is similar to the upside one, but in the opposite direction. Here the pattern forms in a downtrend and it shows the possibility of continuation. The first candlestick is a medium to long red candle, and the second one is a short to medium red candle that is opened with a gap, and its high is lower than the previous candle low. And the third one is a medium green candle that is opened in the body of the previous candle but could not succeed to fill the gap, and it's closed below the first candle closing, which shows that there is more possibility for continuation. Rising 3 method. This is a bullish continuation pattern that appears following an uptrend, and it shows the possibility of continuation. This pattern is made of 5 candlesticks. The first one is long green candle with small shadows, and after that we have 3 small to short red candles that 3 of them are in the range of the high and low of the first candle, and finally a long green candle that closes at the new high above the first candle high, which confirms the stronger buying pressure and possibility of continuation. And falling 3 method is bearish continuation pattern that forms following a downtrend that shows the possibility of continuation. The first candlestick is long and red with small shadows, and after that we have 3 small to short green candles that are in the range of low to high of the first candle, and at the end a long red candle that is closed below the first candle low, which shows high selling pressure and a potential for continuation of downtrend. Bearish separating lines. This is a continuation pattern that forms in a downtrend, and it shows the potential for continuation. We have 2 candlesticks in this pattern. The first candle is green with the size medium to long that opens with a gap, and after that a red candle same size with the first candle that opens with a gap down in the price level that the first candle was open, and this shows that we have a high selling pressure that doesn't allow the buyers to take the control, and this gives the potential for the continuation of the downtrend. And bullish separating lines is the mirror image of the bearish one. Here, following an uptrend, a red candlestick is appeared that is open with a gap, and after that a green candle the same size with the first one that is open with a gap at the price level that the first candle was open, which shows that the buying pressure is very higher than selling pressure, and there is a potential for the continuation of the uptrend. Bullish side-by-side white lines. This is a bullish continuation pattern that appears in uptrends. Here we have 3 candlesticks in this pattern. The first one is a green candle, medium to long, and after that we have a short to medium green candle that is open with a gap above the first candle, and its low price is above the first candle high price. And the third candle, a green candle with the same size with the second one that is open and closed at approximately same level of previous candle, and its low price is above the first candle high price. The third candle was not able to go down and fill the gap, which means that the buying pressure is higher than selling pressure, and it seems that a support level is being established here, which gives the possibility of continuation and not breaking this level and going down. And bearish side-by-side white lines is a continuation pattern that forms in a downtrend. Here the first candle is red, medium to long, and the second candle is a short to medium green candle that is open and closed below the first candle, and its high price is lower than the first candle low price. The third candle is also a short to medium green candle which is open and closed approximately at the same level of the second candle, And for this candle also, its high price is lower than the first candle low price. This pattern shows that buyers were not able to fill the gap, which means that the selling pressure is higher and the resistance level is established, and there is more potential for the continuation of this downtrend. Price is the result of the battle between buyers and sellers, and a candlestick shows how they acted in that period of time and what's the result of the battle. 1, 2, or more candles together form a pattern that shows us what's the stance of buyers and sellers and what's gonna be the possible next move. Just one important point that you must pay attention is that we are talking about possibilities. I repeated many times in each pattern in this video the word possibility. Possibility of reversal, possibility of continuation. These patterns just tell you, for example, buyers overcame selling pressure in the case of bullish reversal, or sellers overcame buying pressure in the case of bearish reversal. All they say is the potential or possibility of happenings, and you must seek confirmations from other tools in technical analysis. As I repeated in each pattern, the most basic requirements are trend or support or resistance levels. If you're not familiar with these concepts, you can check this list later and watch my videos on these subjects. To confirm the signal that candlestick patterns give us, we must have other tools like other patterns, volume analysis, moving averages, MACD, RSI, and many other tools and concepts that we can have them in our trading system based on our needs and preferences. Alright, that's it for now. I want to thank you for watching. If you have any question, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. Please subscribe to my channel. Don't forget to hit the bell and make sure you watch my next videos. Step by step, I'll take it through it. Let's beat the market.